Welcome to Yahoo Finance Live. I'm Shauna Smith along with Diane King Hall. Let's get you up to speed on the market action. 60 minutes to go in the trading day. Once again, you're looking at gains across the board. The S&P up for the fourth day in a row. You're looking at gains for the Dow, just about 55 points. S&P up about 0.8%. The Nasdaq, the leader once again today. This morning, we got another read on inflation data on producer prices, showing once again that inflation is easing. So confirming that trend that we saw from the CPI report yesterday. All three of the major averages, at least starting the last hour of the trading day, in the positive territory here, Diane.
Well, we have some breaking news from the Fed. St. Louis Federal Reserve President James Bullard is stepping down. We want to get right to Washington, D.C. Jennifer Schonberger here with more on this latest development. Jen?
Hi, Diane. That's right. St. Louis Fed President James Bullard stepping down today, leaving that regional Fed bank to become a dean of the business school at Purdue University. While Bullard is stepping down today, he will remain on at the St. Louis Fed until August 14th to ensure a smooth transition. Bullard worked for the St. Louis Fed for 33 years, 15 of the last in which he was president. Bullard saying in a statement, quote, "It has been both a privilege and an honor to be part of the St. Louis Fed." He went on to thank so many people, saying, "I'm so grateful to have worked alongside such dedicated and inspiring colleagues across the Federal Reserve System, and for the opportunity to have worked for so many outstanding directors who have served on the St. Louis Fed board." Today, the Fed losing one of its major hawks. Bullard, perpetually one of the most hawkish members of the Federal Open Market Committee. He perpetually called for more rate hikes than the median. He was also one of the few who wasn't as worried about the fallout from the regional bank failures earlier this year and the possible credit crunch that could ensue, more focused on how persistent inflation has been and trying to get the Fed to move more quickly and more aggressively at the get-go to bring inflation down. The St. Louis Fed's first president and chief operating officer is going to replace Bullard in the interim, effective immediately, as the St. Louis Fed assembles a search team to search for a new president. Given the experience we've seen with the Kansas City Fed, which is still in the process of trying to replace their former president, Esther George, who stepped down back in January, this process can take a while. Again, the breaking news here, Diane, St. Louis Fed President James Bullard stepping down today in order to go to become the dean of the business school at Purdue University. Back to you.
All right. Thanks so much, Jen.
And Diane, when we take into account just what all this means here for the market, for the conversation around what we could expect here from the Fed going forward, and as Jen just laid out, he is actually currently the longest tenured Fed president, right. 33 years at the St. Louis Fed, 15 years right now as president. We know he has been extremely hawkish. He has many times advocated for higher rates, not as worried about what that would exactly do to the economy, saying that it's very, very important to get ahead of it. Right. Now, with him maybe not in the room here going forward, just how that changes the conversation and the view is something that the markets are going to be watching.
And, you know, as you mentioned, he hasn't been a voting member recently, although in the past he was. At the same time, his rhetoric can certainly influence the path of interest rates. We've seen that happen. When he speaks, they listen, and he won't be speaking for a while because he's not doing any public speaking engagements, although we know, according to the CME FedWatch tool, that there is the large percentage expectation, over 90% expecting the Fed to raise rates at the July meeting. So it may not matter what he says right now in the short term. I mean, taking on this new role will allow him to speak even more candidly than he has been, although he has been candid. And, you know, as you mentioned, we know that he has been a hawk and called for interest rate hikes ahead of when we saw them coming.
Yeah, certainly not afraid to go against the grain. 92% right now, traders betting on a hike later this month. All right, we want to bring in Amy Kong, Chief Investment Officer at CI Barrett Private Wealth. Amy, it's good to see you. So before we get into some of the other news of the day, just first, your reaction to this St. Louis Fed President Jim Bullard retiring here from the St. Louis Fed. He's been president there for 15 years, a hawk. How is the market, how should investors be viewing this?
Yeah, I think the fact that he does carry a more hawkish tone and stepping down, the markets may be perhaps receptive to that from the standpoint of the markets being up today. Of course, there's PPI numbers also boosting the story today. But I think overall, it doesn't necessarily change what expectations are for interest rates for July or maybe even for the rest of this year.
So, Amy, one follow-up question I want to ask you. So, sure, it may not change things for the rest of this year, and we know the St. Louis Fed hasn't been a voting member recently, but within the next couple of years, they will be. Do you think that that will change the expectations going forward about what could happen? I mean, certainly, if there's a more hawkish person instilled in the role, that could certainly change the direction of what we expect to happen.
Yeah, it's a great point, Diane. I think, it's depending on how, hawkish or dovish that next person is, markets may react in the very short run. But as I've mentioned in past, sessions, I think ultimately the Fed will be very data dependent. And right now the data is suggesting that perhaps one at the very least in terms of rate hikes could hopefully help seal the deal. But again, it's all very data dependent. And I think at this junction, as you've noted, Shauna, the market is fully expecting a rate hike for July. And what happens after that will obviously depend on jobs numbers as well as CPI and PPI numbers, PCE numbers along the way.
Yeah, Amy, how are you looking at the inflation data that we've gotten out this week? Because once again, we've gotten two data points out. Producer prices this morning, CPI yesterday, pointing to the fact that inflation is continuing to cool. Just what that signals just in terms of future improvement, because now with CPI at just about 3%, the question is what needs to happen to get it down to 2%? What is that next move? What does that look like here over the next several months?
Sure. What we're seeing is a basing effect, right? So essentially very high numbers from a year ago are dropping off. And so that cooling effect is certainly taking place, and that's welcomed. I think what's obviously been holding up inflation is just wage inflation and just the jobs market still being very strong, or at least stronger than expected. And that's something we're very keen on watching quite closely, because as that starts to roll over and we are starting to see cracks in the system, that will obviously be a headwind to a degree towards how consumers will spend and how sticky inflation continues to be.
Given where CPI and PPI came in, do you consider inflation still sticky at this level?
I do. I think ultimately we're looking at core inflation, which has not been moderating as quickly. And, again, when we think about what folks are spending on, the services side to the equation continues to be very strong. And I think, again, because wage inflation is still 4% plus or minus, that continues to be an anchor in terms of how people feel about the economy and willingness to spend.
Amy, how are we squaring this, or how are you squaring this with what's happening in the labor market? Because we are seeing other parts of the economy slow. Yes, we have seen job growth slow a bit, but it's still very, very strong. Once again, above 200,000. Claims also relatively small here in the scheme of things. When are we going to start to see more job losses, or do we need to see significant job losses in order to see that cooling in inflation?
I think you're right. The data has certainly been conflicting, right? And the jobs market continues to come in stronger than expected. Just take a look at the ADP number from last Thursday. It really blew the charts out. So ultimately, what we're thinking is, as long as that number continues to be positive, again, that conflicting data point continues to kind of make economists scratch their heads in terms of how is this going to all pan out. And as long as wage inflation continues at that 4% plus or minus, as I've mentioned, I don't necessarily think inflation will cool off as quickly as investors are hoping for. We are seeing cracks in the system, though. Again, cracks just mean red flags or just signals to watch for. They're not quite wide enough to suggest a recession next quarter, but I think those cracks in the system would be foolish for investors to ignore those cracks.
What are the cracks that you're the most concerned about, Amy?
Sure. So some of the cracks that we're seeing just include typical signals that tend to happen before a recession, including the fact that temp workers or the hiring of temp workers are waning. I think the unemployment rate for certain cohorts are starting to pick up a little bit. And that, again, from a historical standpoint, tends to be the first signs that the jobs market is cooling off. Mind you, the jobs market is also a lagging indicator. And so we are very much paying attention to leading indicators, which will include sentiment, ability or willingness to to invest in CapEx, the growth rate of the money supply, all of those as a collective has actually peaked, in our opinion, in May of last year. And typically history suggests that if it peaks, maybe 12 to 18 months, maybe 24 months out, you start to see, again, the economy rolling over. It's also interesting to note that over the past 50 years, there hasn't been a recession where the yield curve hasn't inverted. And so that's another signal that we're watching quite carefully as we think about whether a recession might materialize.
Well, Amy, investors also very closely watching what's going on with earnings, and earnings season is now officially here. We got two big reports before the bell today, Delta and PepsiCo. When it comes to Delta, they delivered a huge beat, and they also hiked their full year outlook on record quarterly earnings. CEO Ed Bastian expecting the consumer to stay strong, forecasting a jump in revenue of as much as 14% on the year. And then PepsiCo brushing off any signs of a consumer slowdown, at least for now. The company behind brands like Doritos and Lay's chips, they beat the street's expectations and now see 10% organic revenue growth in 2023. Amy, we know the bar has been set very low for earnings season this time around, but beats like we saw from Delta and from PepsiCo, is that enough for this market's momentum to stay intact?
Yeah, I think, in the case of Delta, we would expect good numbers from them, only because the international travel component continues to be very strong, and Delta, United, a lot of these national carriers should benefit. PepsiCo posted very good numbers, and we obviously welcome that, but we are starting to wonder how much more pricing can they pass through to the consumer? And volume continues to be a question mark for them, because ultimately you need both components to really, again, drive earnings forward. And while pricing has been a welcome sign, again, we do question as the consumer starts to lose steam a little bit, right? Excess savings starts to come down, wage inflation also moderating. How much more pricing can that take place? And that's something we're going to watch pretty carefully across the board, not just with the consumer stocks, but across multiple industries in terms of how much pricing power is still left.
So, Amy, I want to ask you, so what kind of tone does this set for the rest of earnings season, particularly when you think, I know we're just at the very beginning, when you think of the consumer-facing companies?
Sure. I think the bar is set low. I think to Shauna's point, year over year, I believe expectations are down about 7% from last year's second quarter to this year. And I think the energy component will likely be softer. We are going to see the banks report. I think the consumer, again, depending on what sub-industry, they're likely to hold up because we are still seeing some excess savings. Wage inflation, as I've mentioned multiple times, continues to be still trending positive. And as we think about the earnings season for retailers, it's really going to depend, right? Goods manufacturing or goods retailers might be a little bit softer versus services. And so we're going to be watching those components quite carefully.
Amy, what does all this mean for investors' portfolio positions, just in terms of what you see leading this next leg if we do end up higher from here?
Yeah, we are cautious as we think about client portfolios and their positioning towards stocks. As an investor, you never really say no to a rally like the ones we've been seeing since beginning of this year, but we are a little bit uncomfortable in terms of how we've gotten there, because really it's been multiple expansion. And the fact that we do expect earnings to soften for this quarter as well for the remainder of the year, it kind of gives us a little bit of cautiousness here in terms of how can the market sustain a 20 plus price to earnings multiple. And so as we're thinking about client portfolios, we are mindful of that. At the end of the day, we're still looking for quality. You've got to understand what you are owning in this kind of environment. Pricing power continues to showcase itself across certain companies and industries. But again, we're questioning how much further room there is. And at the end of the day, I think investors, just given the regional bank meltdown and such, are looking for quality balance sheets. And so that's, again, top of mind for us as we kind of digest through the next couple of weeks of earnings.
Amy, let's talk about one big play, AI. So it seems the generative AI hype isn't slowing down anytime soon. Investors have poured money into AI stocks this year. Market leader NVIDIA, that stock up 208% since the start of January. So, Amy, some investors cannot afford NVIDIA where it is now. So what opportunities should they be playing in if not NVIDIA?
Sure. We like the mega trend, right? AI as a mega trend, we think can be applied across multiple industries. But, realistically, the execution of AI will hit some bumps along the way. There could be regulation talks. There could be just the idea that, perhaps the information that these bots spit out could have some flaws in it. And so, again, the steam or the momentum, if you would, could die down. Ultimately, NVIDIA is a pure play, but we try to play the AI theme through multiple channels. I think hyperscale cloud infrastructure is one way of doing it. That would be including companies like the Amazons and the Microsofts of the world. Microsoft, of course, is also got the opportunity to invest directly in AI Open, which obviously is the maker of ChatGPT. And then, of course, when we also think about strategic consulting, a lot of companies are thinking about how do you implement AI? And I think companies like Accenture could be another interesting way of playing it, again, because of their positioning within the strategic spectrum.
Amy, how are investors or how are you approaching earnings season this time around when it comes to AI? Because over the last 2 quarters, we have certainly seen a lot of hype, even if a company just mentions AI and its plans here for the future. But are investors going to be holding some of these firms, I guess, accountable just to start showing how it's actually improving their business?
I think you're absolutely right. And that's likely to take place in the coming quarters. Certainly when you have a big mega trend like this erupt, a lot of the initial buzz is just momentum, right? Everyone just wants to get into anything that mentions the word AI. But I think ultimately that starts to cool off, that starts to moderate a little bit, and investors will start to question, okay, now that the tide has lifted all boats, let's figure out which of the companies can actually make money off of AI. And that's what we're very focused on. We're also focused on valuation. So we're really trying to balance out, let's cut out some of that momentum and think through PEG ratios and such so that we are comfortable owning the companies that can actually materialize earnings through this AI megatrend. And so I think ultimately you will start to see some of that moderate if companies can't deliver on what they've promised on the AI spectrum.
Amy Kong, CI Barrett, Private Wealth Chief Investment Officer. We appreciate your deep dive from Fed to AI, whether it's friend or foe. Thank you, Amy.
Thank you.
All right, we're just getting started here on Yahoo Finance Live. Coming up, the state of the airline industry. Delta Airlines posted record quarterly profit and sales for the second quarter, but will the positive momentum continue for other airlines? We'll discuss. And Bob Iger stays on. Disney CEO will remain in charge until 2026 as the entertainment giant contends with issues on various fronts. We'll break down what this means for the company's immediate future. Don't go anywhere.
Let's do a quick check of the market sponsored by Tasty Trade. You're looking at gains across the board. The S&P up just about 0.8%. The Nasdaq up about 1.6%. Technology leading today's trading action. The producer prices report that we got out this morning showing that prices once again cooling last month. That is adding to some of the optimism on the street here this afternoon. So again, Dow, S&P, and Nasdaq trading in the green. Communication services, consumer discretionary also among the leaders, as well as a technology today. Also taking a look at the VIX, the fear gauge index has been under pressure and falling even further today, right around 1343. All right, well, it has been a wild day for Disney. Bob Iger is staying on as CEO for 2 years longer than initially planned. And he's also given some clues about the direction of the company. Yahoo Finance's Alexandra Canal has been digging into all of this. And Allie, what can we expect?
Hey, Shauna. Well, a message from the Magic Kingdom. Expect some things to stay the same while others need a shakeup. Here are 5 headlines I'm watching from Disney that came out over the past 24 hours. Number 1, Bob Iger staying on the throne at least through 2026 or so, he says. Disney's board of directors announcing late Wednesday the storied leader will add another 2 years to his contract. The additional time comes with financial compensation, an annual bonus target equal to 500% of his annual salary. Not too shabby for Bob Iger there. The confidence boost from the board comes at a time when shares of Disney are a bit under pressure, down about 2% since his November takeover. Next up, Iger's vision. Disney will take a, quote, expansive look at the media giant's TV assets, which include network ABC, along with cable channels like Freeform, National Geographic, and FX. Iger declined to say what exactly he meant by the word expansive, but it likely suggests a sale maybe on the horizon after he admitted the current distribution model is, quote, broken. Still, one of Disney's assets not up for sale is ESPN. Iger saying sports stands very tall in the media landscape and that the company is open to strategic partnerships to get ESPN into the direct-to-consumer landscape. Iger name-dropped Apple and its VR headset, which he said, quote, lends itself to sports. Some analysts have speculated whether Apple should buy Disney, but more importantly, analysts have also debated the impact of Disney's DeSantis battle and what that's had on the parks business. Iger says, for now, no impact at all, saying he has, quote, huge optimism for the parks moving forward. Finally, Iger weighed in on the Hollywood strikes. We just got the announcement that actors will be joining writers on a strike. He called it, quote, very disturbing and very damaging to the business. He did not mince words, saying the unions have demands that are, quote, not realistic.
All right, Allie, thanks so much for that. Stick with us because we have a lot to talk today. You have certainly been very busy over the last 24 hours. But let's start with that breaking news. Hollywood is shutting down. The SAG-AFTRA union will go on strike at midnight. This on top of the writers' strike. Now, it's the first time that both unions have been on strike at the same time in 63 years. Joining us now is Jason Helfstein, Managing Director and Head of Internet Research at Oppenheimer. Jason, it's good to see you here. So obviously the strike, a huge blow to Hollywood. But when it comes to your coverage list, which includes Netflix and Amazon, the streaming impact of all this, how do you see that playing out?
It's actually probably a near-term tailwind, actually, to Netflix and the streamers because they produce content generally further ahead, so not kind of not several weeks before airing, but many, many months before airing. Plus, Netflix also produces a lot of content around the world, which wouldn't be impacted by this. So if you think about, during COVID, when production was shut down, Netflix was actually able to kind of have a more consistent pipeline of kind of newer shows on top of just the very deep library. So while we don't wish anyone to be out of work and we hope this gets resolved for everyone's interest, it probably will be a near-term benefit to the streamers, if the strike, both the writers and the actors, don't get resolved reasonably quickly.
And Jason, for Netflix specifically, that platform has been very focused on international content, committing a ton of money overseas, especially in South Korea. Is that going to be a tailwind for Netflix and when you compare that to some of the other streaming companies and their content pipeline?
I mean, again, I like the idea, and I think everyone, we're talking with watches Netflix. I mean, we've all kind of, before Netflix, I didn't watch many shows that had subtitles. I think we've all, Netflix has gotten us used to watching shows with either subtitles or dubbed. And so, yeah, they've really trained consumers, hey, you can watch, there is good content that's not necessarily made in the US or Canada, that's appealing, and it's among some of their top shows. So yes, that in addition to the fact that they produce content much further in advance and kind of have it in the can ready to go, as they say, you also have that international content. So yeah, I think that will be a near-term tailwind for Netflix.
So Jason, outside that international content, I know you're saying that's a tailwind here, at least for now, but is there a point as to which that conversation would change if this strike is not resolved for a certain amount of time? Should Netflix, or will Netflix, get a little bit worried just about the amount of backlog that they still have to rely on?
Sure. I mean, again, eventually you start cutting into muscle. As far as our discussions with Netflix, our understanding is nobody thinks it'll go that far. I mean, if this went 6 months, again, hopefully it doesn't, but if it did, I think Netflix you'd see very minimal interruption. If this went for a year, yes, you probably would see interruption. But I mean, if it went for a year, I think the pain that this will cause on the traditional media business is going to be far worse. So I wouldn't expect it to go that far.
And Jason, besides the strike, another big headline we got is Disney CEO Bob Iger staying on for another 2 years. He gave an interview with CNBC this morning, and he really doubled down on ESPN, saying it's definitely happening that they're going to take ESPN as a fully over-the-top direct-to-consumer service. How much more pressure does that put on a company like Netflix to get into the live sports game?
I mean, we know sports rights are expensive and only getting more expensive. You've got all of the internet giants trying to figure out what their strategy is going to be with sports, and those companies have the biggest checkbooks right now on the planet when it comes to sports. So I don't think Netflix wants to compete with them. What we've seen them do is effectively do these sports-related shows, Formula One, the golf series, and they've gotten really good viewership. So, I think you'll see more of a continuation effectively of them being able to kind of leverage the popularity of sports, but doing it in an alternative way and not bidding on live sports.
Jason, the challenging setup, though, that we have right now across the streamers, really across the media landscape, but since you cover streamers, focusing on that aspect of it, Bob Iger commented in a CNBC interview this morning that it's even more challenging than he had anticipated. How do you see that unfolding here in the near term, and the companies that are best positioned to navigate this tumultuous time? Is it a name like Netflix?
Yeah, look, I mean, I think Mr. Iger was being purposely vague. I mean, the reality is I think that you're seeing, kind of cord cutting and kind of the decline in traditional TV viewership. That is part of a challenge that, again, I don't cover Disney, but that's what the companies are trying to face, which is we want to build a successful streaming business, but we also have this cash, historical cash cow out of our legacy business. Can we do both? And how do you do both well and, profitably? And if you're going to choose to not put a show on linear, because ultimately it's going to drive people to your streaming service, that's then going to hurt your linear service. So, look, Netflix doesn't have to make those decisions. I think that's ultimately the challenge. And then if you have legacy cable channels that you're still getting paid, good cash from the cable operators, but that whether it's going to be 5 or 7 years from now, that cash will probably go away, factoring that into your strategic planning. And so I think that's more what he's referring to, not necessarily, what is a standalone company, like, is the environment actually worse for Netflix right now? I actually think it's really better. But for the media conglomerates, it's, trying to get the two parts of the businesses to ultimately work cohesively. That's the challenge.
And Jason, you said Netflix doesn't have to make those decisions. However, it is getting into the advertising game with more people cutting the cord. That's more of an opportunity to get those ad buyers. How does a company like Netflix and all of these streaming services focus their advertising tiers right now?
So, I mean, look, it's super early on Netflix. Their challenge is actually there's more advertiser demand than they have ads to fill. This quarter, they finally launched paid sharing, right, which is effectively telling you that you can only pay for 2 basically viewers outside of your household. And then after that, those other people have to get additional accounts. Maybe they go to the ad tier, maybe they go to the basic tier. They're testing in Canada, phasing out the basic plan, which would effectively, put more people in the advertising tier, because the argument would be at that basic plan, you were giving away about $10 of advertising a month when you were letting somebody, sign up for kind of the lowest subscription tier. So we think Netflix is in a very good place right now. Again, they have what is considered, it's all premium content, right? There's no user-generated content where you're not sure about, appropriateness for an advertiser. So this is all very premium content. Advertisers know they need to do more connected TV advertising because a lot of the linear dollars are wasted because they're not targeted ads, right? You're showing ads to people who either it just may not be an appropriate product for who that person is, where on streaming you can target those ads. And so look, super early days. We do ultimately think there's the potential of 30 million additional users that come on Netflix, and half of those easily could go into the ad tier.
So Jason, with all of that taken into account, we're going to hear from Netflix when they report results next week. What do you think we'll see? Do you think we're on track for a big beat?
We do. I mean, and I think the street's already expecting. If you look at the stock, is continues to do quite well. We're looking for 2.6 million subs versus guidance of 1.8, street's 1.9. But I'm sure the buy side is, probably where we are ahead of us. For next quarter, we're looking for something like 5.2 million new subs, streets at 5.4. And then it's really what do people do with their estimates for next year when people start to give them credit for advertising, because we're valuing the stock on a 2025 earnings estimate, right? So really this isn't about what's the advertising tomorrow, but what's the potential over the next 2 years, and what do they say that will more positively inform people's view about the next 2 years.
Yeah, a lot to look out for in that report. Oppenheimer's Jason Helfstein, thank you so much.
Thank you.
Coming up, Delta is starting earnings season off on a high note, but will other airlines soar? Up next, we'll speak to Helene Becker, TD Cowen, a senior research analyst, on what she expects for the industry this earnings season. That's next.
Pent-up demand for travel driving Delta earnings to a record high. The airline also boosting its full year guidance. Joining us now is TD Cowen senior research analyst Helene Becker. Now, Helene, you had predicted that they would post record numbers previously. You predicted that for this quarter and even the coming quarter. What's your first takeaway from today's numbers?
Thanks for the question. The numbers are very good. Demand is very strong, and you see that at airports around not only the United States, but around the world. People really want to make up for lost time and are getting out and traveling. Excuse me. And the fact that they have the ability to do so, not only from a financial perspective, but from the time perspective. The fact that they can travel, make almost any weekend a long weekend because of work from anywhere opportunities.
Helene, is this a case across the board, not just Delta? And also more specifically, the comments that we heard from Ed Bastian when it comes to corporate travel. He was very optimistic that that is going to continue to move to the upside here. What does that growth look like? Are we ever going to get back to those 2019 levels?
Yeah, I think that's a really fair question because he mentioned, and he mentioned on the call this morning, and we've said this before, the U.S. economy is, 15-20% bigger now than it was 4 years ago. So it just in terms of the size of the economy, it should drive higher business traffic. It's just, there's this hybrid work environment. And when you plan a business trip to go see your clients, it's increasingly difficult because some companies are in the office Monday, Tuesday, Thursday, others are in Tuesday to Thursday. It seems like Friday is a work from anywhere day. So I think it makes travel from a business perspective more difficult. We certainly have seen growth in attendance at conferences. We're pretty much back to 2019 and prior year levels from that perspective. And our view has really been evolving that into this more, yes, we're going to see more business travel. It's just where you're going to see it, I think, is changing. Small and medium-sized companies have never really stopped traveling. It's just the large corporates, tech, financial services, as an example, that have curtailed travel. And I think as your competitors travel, because who travels? Salespeople travel. As your competitors travel and they win business, I think you'll see people start to get back on the road.
Helene, I want to ask you about just the pricing power. We know fares are much higher. Inflation in general has been sticky, although it's started to cool. Let's talk about the level of fares, where they are, what the risk is. Does Delta still have pricing power heading through the balance of the year? Even, yes, their guidance is strong, but what is the headwind that you see?
Yeah, I think that's, again, you guys are really on top of it today with your questions. So I think from a pricing perspective, jet fuel prices have come down off their peaks. They're significantly below where they were a year ago. And that gives the airlines some opportunity to cut fares to continue to see strong demand. We're seeing domestic fares come down a little bit on a year-on-year basis. And although May was up sequentially from April, that kind of makes sense because the summer months start, I guess, May, through July, especially if you're in the South. Schools go back in early to mid-August. In the North, schools don't go back until after Labor Day. So you have this elongated season where you can have strong demand that would drive higher prices. Plus, capacity in the New York area, as you guys are probably aware, the Department of Transportation asked the 4 big airlines serving the market, United, American, Delta, and JetBlue, to cut capacity by 10%. And capacity is already down by 10%. We are not back to 2019 capacity levels. But as I mentioned, the economy has grown and demand is fully back to 2019 levels, or and some days it's above. And so when you think about that, and when you think about the ability of airlines to price, intuitively they should be buying more aircraft, but they can't do that because of OEM delivery delays, supply chain issues, and then all the other limitations on growth. There's no place to put planes at the busiest airports. So we've been for the past 4 or 5 years talking about more seats per departure and fewer departures per day as the only way you're going to be able to get growth. And now the airlines are starting to talk about that as well. But it definitely drives higher revenue in an environment that if you see a slower economy, you would normally see slower revenue growth or declining revenue.
And Helene, to that point, because Delta did say on the call that they believe that they've reached an inflection point when it comes to cost, but you brought up some of the issues, some of the headwinds that are facing Delta, many of its competitors today. To what degree should investors be worried about those lingering cost issues, given the fact that we are seeing pretty significant delays for some of those aircrafts?
Yeah, I think that from that perspective, we're concerned, but not as concerned as we would be if the revenue environment was slightly different. So some of the costs that you see pressure, labor costs obviously we've been talking about that for a long time, as have you, and we're seeing that percent change should start to abate in 2024. Maintenance, as airlines get new aircraft, you should see a maintenance holiday just because the newer aircraft need less maintenance than older aircraft. So that type of thing should start to abate. But the other issues that are out there in terms of supply chain, labor, it's not so much attracting, it's retaining. Air traffic control has been an issue. There seems to be bipartisan support for an FAA reauthorization bill, which needs to be done before the end of the government's fiscal year. So I think there's a lot of good happening that should make 24 a better year. Well, at least we're hopeful. Maybe hope isn't a strategy, but we're hoping that things improve on the cost side.
All right, Helene Becker, we have to leave it there. Of TD Cowen, thanks so much for joining us.
Thank you.
Markets on track for another day of gains as wholesale inflation rises less than expected in June. Some of the biggest movers as of late, they're meme stocks. Jared Blickery is here with a closer look at that meme trade, what it means for the broader market, some buying activity again.
Yes, and that's not always the best thing for the broader market, although that may be changing. First, let's take a look at some of the stock movements over the last 2 months, which I have here up on our heat map. You take a look at Palantir, that's up almost 80%. Coinbase, lots of crypto news today. It's right there with it. Here's Palantir. You can see it really perked up in May and is holding on to these gains here as it consolidates. Take a look at Coinbase as well. As I said, up about 86%. It's really taken off today, although yesterday it was just breaking through this resistance line that we saw from earlier in the year. I could go through a couple other notes. Carvana's on there, but Ines Ferre is going to be talking about a JP Morgan call on that stock after the break. But let me just show you 2 others. Beyond Meat, and this is a stock that had perked up earlier in the year. You saw some meme-like spikes, I would call those. And is this another one? Hard to say, although the volatility is expanding as the price is going up, and that's kind of a hallmark of those meme stock moves that we've seen. Here's Kodak. This is another one that was really subdued for most of the year. I can show you 3 years or a couple years ago during the meme stock craze, it did really spike up to $60 per share there. Just a shadow of that today to show you where it's come from, but Kodak on my radar too. Now, what I've noticed going back to last year is that when meme stocks spike, that tends to be a signal that the general market is about to roll over. And I've plotted 7 of my favorite meme stocks here that seem to have a little bit of predictive value and charted them on the S&P 500 going back to the beginning of 2021. Now, this was a bull market, and you can see some of these clusters predicted small pullbacks in the market, but it was really last year. They would spike in this bear market. Anytime you got a spike on these meme stocks, you would have the market kind of retrace shortly thereafter. Here are a few more, but an exception. So with this last squeeze up at the beginning of June, we didn't see a retracement really of any kind. The market just sped up here, and now we're seeing another cluster. So the big question on my radar is, are we going to see the market roll over, or is it strong enough it's just going to rise with these meme stocks? We'll have to see, guys.
Hoping for the latter there, Jared. All right, Jared Flicker, thanks so much for breaking that down. All right, coming up, a sore spot for healthcare. The industry is having a slow run to the start of the year, but don't count out the sector just yet. We've got a guest coming up telling us why he's bullish on some of these names, one of them being Abbott Labs. More on that when we come back.
Shares of Carvana decelerating down 2% after JP Morgan Chase downgraded the stock to underweight from neutral. The investment bank citing Carvana's valuation, saying it's disconnected materially from its fundamentals. Yahoo Finance's Ines Ferre has the details for us. Hi, Ines.
Hi, Dan. Yeah, and you can't make this stuff up with this stock because right now it's down 2.5%, as you just mentioned. But earlier today, it was down 10%. Yesterday, it was up. Well, what a wild ride for Carvana. As you mentioned, JP Morgan analysts basically saying that they are underweight now, this stock, saying that they put a $10 price target on it because they believe that the valuation has once again disconnected materially from fundamentals. Also, JP Morgan analysts suggesting that the Carvana should be offering stock when their stock price reached $24 a share, that they should be raising money when it had reached $24 a share. Now let's take a look at the stock right now. It's at $37.97 year to date, 700% year to date. Just remember that this stock was trading at around $4 a share last year. In fact, its low was around $3.55 back in early December when there were concerns, speculation about a possible bankruptcy. So the way this stock has completely skyrocketed is pretty amazing.
Now, Inez, short sellers have piled onto this stock, which has really amplified the move to the upside. Is there more room to run?
Yeah, look, right now the short interest on Carvana is 54% of the float. That is a heavy, heavy short interest. And this is according to S3 Partners. They're a data analytics firm, and they have crunched the data here. So this is a highly shorted stock. You saw stock moves with this stock earlier this year when in June, Carvana revised its outlook. You saw the stock go up 56% in one day. That is a short squeeze. That is when these shorts have to cover their positions, and that exacerbates the move to the upside.
All right, Inez Ferre, thank you so much for the deep dive on Carvana. Stocks are on the rise in today's trading session after Producer Price Index provided further evidence of inflation cooling. This coming as companies start earnings season stronger than analysts' expectations. So what stocks should investors get in, and which should you wait on the sidelines for? Here to discuss, we have Gradient Investment Senior Portfolio Manager Jeremy Bryan. Jeremy, thanks so much for joining us. Let's start with your picks. You're starting with the healthcare space with Abbott Laboratories. Tell us the thesis on this one.
Yeah, healthcare in general has kind of been left to the sidelines a little bit after admittedly a very strong 2022, but especially with Abbott, what we're starting to see here is a reacceleration of growth. Abbott had a huge influx because of COVID conditions where elective procedures went away, but you had testing and all the other stuff that they were involved in. And so it made the earnings trajectory pretty noisy because you've had a pretty significant correction of earnings here. They're expected to be down. But what we're starting to see is a reacceleration of that profile. As the COVID things start to end off, they're getting those elective procedures back in. And then secondarily, the diabetes franchise has actually had some technology improvements here recently that could actually increase their penetration rate there too. So we really think that this is a reacceleration story. It's not cheap, but it's cheaper than it has been in the past. And that's why we own it now and we'd be buying here.
Now, why do you think Abbott Labs is more of a pick than, let's say, a Johnson & Johnson, for example? Because we have seen Abbott Labs kind of relative to their peers lag a bit.
Yeah, I mean, well, Johnson & Johnson especially, they had the KVU spinoff and they have other components of their business, right? It's a pharma business and then the devices business as well. So, I mean, Johnson & Johnson to a certain extent is a little different from, what people they look for and invest in there because they probably honestly talk about pharma more than they talk about the devices component of Johnson & Johnson. But really from that perspective too, is that some things in healthcare have worked okay. I mean, if you look at Boston Scientific, that stock has been phenomenal. But then other areas have really just been left behind. And to a certain extent, I think it's, again, a source of funds for what has worked well this year, which is, the AI stocks and those kinds of things, and industrial reopening. I think people are pivoting out of that. But again, from our perspective, that is actually providing the opportunity to say now is an interesting time because you're getting a little discounted valuation. It's been kind of left to the sidelines, and we do think that earnings growth is going to accelerate in the next couple of quarters.
All right, you called Abbott at around, today it's around 107. That I guess it might be pricey, but your next pick is United Health Group. That's certainly pricier. What's the case for that?
Yeah, and we'll find out a little bit more real soon here. But from the perspective of United Health, I just think insurance stocks are, United Health is probably the one that's trading the most expensive, but it's also the best executor in that group. But I just think health insurance is actually one that's been materially left behind here recently. And Cigna is another one I would call out in that regard. And both of these companies are going to grow in probably the high single-digit to low double-digit EPS range for the next 3 to 5 years. And we're paying a pretty significant discount to their long-term valuations here, especially with United Healthcare. Again, that one's a little bit more expensive, but I'm willing to pay up a little bit for the growth. But if you're looking for like a true value play, that would be more of your Cigna. But I just think UNH and Cigna have been left behind because of these elevated concerns about their cost environment. We think that's a little bit overblown. UNH has already called it out. We'll see what the earnings reports show, but because they already kind of put it in there, we think that's already somewhat priced in, unless the numbers are significantly worse than anticipated, which we don't see right now.
Okay, I'll try to do this quick because I kind of have a two-pronged question now. So we know United lost some steam this year because of them coming out and talking about the rise of elective surgeries
Sure.
and how that can pressure their margins. What are you looking for from the earnings tomorrow in terms of that, what their margins look like?
Yeah. I mean, honestly, it's more important to me the commentary. I want to say that, if they come out cautious and say things are getting, we've seen progression that it's getting materially worse, that would obviously be a little bit more of a red flag for us. But if they're saying the exact same thing that they already said in mid-June, and by the way, they don't bring guidance down significantly as a result of that, that would give us an indication that they are at least comfortable with their level of increased cost and that the pricing environment will be positive enough for them to continue to grow that earnings in that double-digit clip. But that's really what we're looking at, is what's the commentary with regard to the cost environment. Is it getting worse than when they talked about it before? Is it starting to alleviate? Where are we at in that cycle, if you will?
And Jeremy, you also have some stocks that you're saying to stay on the sideline. One of them being Oracle. Why do you think that?
Yeah, Oracle's one we just sold this week, and it's really, this is more of a profit-taking move. And if you're a new entrant into it, I wouldn't be buying it now. So we sold it this week. I mean, we bought it in October and get 85% out of it. I mean, that's, phenomenal in any stretch and anything that we'd be looking for. But you've gone from when we bought it, it was 13 times earnings. Now it's over 20 times earnings, which is near a 10-year high for that stock. So we're just saying from our perspective, now is probably not the time to be entertaining a buy into Oracle with this significantly higher multiple. And we still don't know what the extended benefit of AI. We actually think they will be an AI beneficiary to a certain extent, but we don't know how far and how fast that goes. And they've been rewarded for a lot of that already. So that's why we're saying that, hey, fundamentally, there's really not much wrong with the company. But if I'm buying a position today, or if I'm holding it today, I'm saying that maybe it's a little bit expensive and I'd maybe want to look to other avenues for future growth.
So that's interesting. You do have a bunch who agree with your thesis on Oracle and a bunch who don't. It's kind of like almost split down the middle. So we'll see where that one ends up. What else are you staying away from, Jeremy, or getting out of?
Yeah, I mean, honestly, we're again looking a little bit at these industrial plays, and we're just, Fastenal is an interesting example of that today. So I'm going to pivot a little bit here and saying, we've been talking about this before and saying the industrial renaissance in U.S. manufacturing is real. There's no question about it. But we were a little bit nervous about how far and how fast some of these industrial names have come. And so Fastenal was an interesting thing today in the effect that numbers weren't that bad and the stock has had a re-rating downward. And its peer competitor, Grainger, was another one in that regard that actually had a downgrade this week as well. And so from that perspective, we're just saying be careful with these types of names that have run really far, really fast recently here on the thought of U.S. manufacturing renaissance and those kinds of things occurring, because while we do think that is occurring, we just thought this was too far, too fast. And so both of those names were on our list and saying, we just need to be careful here. It's not a name we'd be entering in right now. We'd want to see it settle down and kind of come back to an area where the valuation makes a little bit more sense for the opportunity going forward.
All right, Jeremy Bryan, we got to leave it there. Thank you so much. Coming up, the closing bell on Wall Street. We are checking in on the latest market moves and the top trending tickers. Don't go anywhere.
And that's the closing bell on Wall Street. We're looking at gains across the board. This market check sponsored by Tasty Trade. The Dow closing up just about 44 points. S&P up above 4,500, closing up nearly 1%. The Nasdaq, the leader, that has been the case at least all trading action this afternoon. A couple of things driving markets to the upside. We got another reading on inflation pointing to slower growth here for prices. Obviously, the market taking that as a bullish sign here that maybe the Fed won't need to be as aggressive as it has signaled on higher rates. And then also St. Louis Fed President James Bullard saying that he has resigned. We know that he has been one of the most vocal hawks as a member of the Fed. So the market is trying to figure out what exactly this means for future rate hikes and the conversations that are going on inside the Fed. All right, let's take a look at some of the individual movers of the day. Let's start with Progressive. That stock sliding into the red after earnings lagged the street's estimates. We're looking at a drop of just about 13%, and that is the biggest drop that we have seen since 2008. It's one of the worst performers in the S&P. So obviously these results, Allie, disappointing the street.
Very
Wells Fargo out with a note saying that it shows that the auto insurers are continuing to be impacted by, quote, elevated severity. And we're seeing that caution reflected in some of the competitors as well.
Yeah, and insurance has gotten more and more expensive, but also fixing cars has gotten more expensive. So that obviously pressures margins. I'm very happy I don't have a car, so I don't have to worry about car insurance right now. But it is interesting though, because there was a research report from JP Morgan earlier this month saying that Progressive is a leader in this space, but that the stock is fully valued at this point. But clearly a lot of challenges in the insurance space as well.
No, it definitely, I mean, look, I have a family member who's there who gave me kind of a heads up that this was things were a little rough there. So I'm not as surprised to see these actual numbers play out today. I said, maybe you should start looking for somewhere else. I'm sorry, that's a little bit of a sidebar. But we also know that we've talked about this before, cars becoming more expensive or maintenance because people are keeping their cars for longer. The length of time, the duration, people keeping their cars around 12 years. Again, that putting pressure on the margins in terms of just the cost to insure the vehicle. Want to switch gears to another stock that we are watching. Shares of Amazon popping today up a little more than 2.5% on the back of its annual Prime Day event. Adobe Analytics estimating online spending shot up 6% to $6.4 billion on the first day alone. The projection for both days topped $12 billion. I know going into this, they were expecting to see above $13 billion. We'll see when it all shakes out. Now, Amazon, of course, we know doesn't reveal its total sales for those 2 days, but consumers bought more than 375 million items during the event. That's what Amazon says. Did you guys buy anything?
I bought some things. Yeah, I can never really stay away from Amazon Prime. They get me with all of their deals. They're too good to pass up. But a couple of things did jump out to me in these results, and really what we heard from the report from Adobe, and that's the fact that average order size was up 3% on a year-over-year basis. Obviously not a huge surprise given inflation, given the fact that these goods do cost more, but more shoppers were using buy now, pay later. And that certainly is just a sign of the times that we are in right now. Consumers more strapped for cash, and they're using that option so they don't have to pay the full amount, at least up front.
And it's hard to draw, concrete conclusions about what this means on the state of consumer. You don't know if people are buying things down the line for the holidays, for Christmas, for birthdays, what have you. But $2.5 billion saved via some of these deals, and now I'm regretting not getting in on these Prime sales. I didn't.
You always have to have a list ready for a day like this.
I know.
You don't. I mean, obviously, I am not advocating the buy now, pay later kind of program, but I have my list for days like that, and I save, like I have a few appliances, and I'm like, so I got a blender. I'm finally a proud owner of a Vitamix.
Oh, there we go.
That was a good investment. That was a good buy.
Yes, that's worth it.
And especially because I price compared it to last year's Prime Day. It was the same price, even though the normal price is higher this year with inflation. So even with where inflation is, they didn't cut the discount. I appreciate that.
No, but clearly this is such a huge days for Amazon, and they pour a lot of money marketing into this, whether it's online, TV, what have you. So good for Amazon. One stock I'm watching is Perrigo. Their Opill oral contraceptive has become the first over-the-counter birth control approved by the U.S. Food and Drug Administration. Shares closing roughly flat, but they were up more than 4% earlier today on that news. And guys, this is a big deal, especially in the United States. The company said it will likely be available in the U.S. in early 2024. But what's interesting is that this pill was available with a prescription since 1973. So it took 50 years to get this to be over the counter. It is available without a prescription in over 100 countries outside of the U.S. So the U.S. lagging there, but a big win for reproductive rights for sure.
It is. I mean, this is a huge milestone in general for women, and just where we've come and the issues we've had to deal with recently. But one of the things that could be affecting the stock prices, we don't know the price of this. You know, so how will that play into what it does revenue-wise for Perrigo and in terms of its bottom line in general? But it's a big win for women.
It certainly is a huge win. And going off of what you're saying, just in terms of we don't know what the price is yet, we also don't know what insurance coverage is going to look like, because insurers are not mandated to cover a pill that is over the counter. It does not hold up to the same standards as what is that you need a prescription for. So there's so many questions just in terms of what people are going to have to pay on a monthly basis if they do want to buy the pill. So it does remove the barrier given the fact that it is over the counter. But that cost is certainly a massive variable here, just in terms of wider adoption.
And the company did say they want it to be affordable, but that's relative, right? Like, what exactly does that mean? We do need
what that will be, but a huge day for women in terms of just the availability of it. All right, Allie, we appreciate you helping us with all of this. All right, Federal Trade Commission Chair Lina Khan grilled by House Republicans Thursday in a hearing before the House Judiciary Committee. Now, this coming just days after the FTC suffered a setback when a judge ruled the Microsoft Activision Blizzard deal can move forward. Here with all the latest details, we have Yahoo Finance's Alexis Keenan and Dan Howley. Now, Alexis, we'll start this off with you and just set the scene for the hearing.
Okay, well, it was a long hearing. It was, I believe, 4+ hours, and it really ended up being a wide-ranging one, an interrogation of Lina Khan, at least by conservative lawmakers, and it really turned into questions over how the FTC is wielding its power to regulate competition and also protect consumers from unfair business practices. Now, Khan's leadership has been lauded by the left and criticized by the right for aggressively interpreting antitrust and consumer protection laws, and she's gone after, as you said, big tech, healthcare mergers. You've got Meta, Microsoft in there, also Illumina's recombination with Grail, and also business practices for Amazon, for Twitter, and others. And this week, as you also said, there was a losing streak edition for Khan when a federal judge had ruled that it would not grant an injunction to the FTC to stop the Microsoft and Activision Blizzard transaction from going forward. Now, I want to take a listen to one of the Republican lawmakers that really captures the sentiment of the right during this hearing. It's Representative Darrell Issa. Here's what he had to say in his exchange with Lina Khan.
Our problem here today, my problem here today, is that you're a bully. I believe you've taken the idea that companies should have to be less competitive in order to merge, that every merger has to be somehow bad for the company and good for the consumer.
We laid out our view about how the antitrust laws apply in nascent markets. There is significant case law around how it's incredibly important to be protecting competition.
So Khan was going on there to say that she brings cases only where the FTC finds that the law has been violated. She said, unfortunately, sometimes things don't go the FTC's way. You also had Representative Kevin Kiley of California saying, why should Americans trust the FTC's judgment? Why should they go in this direction with Khan? But at the tail end of the hearing, you had Khan kind of making a nod to her philosophy on the antitrust laws and consumer protection laws, saying that concentration and concentration of economic power, she said, hurts really everybody.
And Dan, when it comes to Microsoft and how Activision is just viewing the FTC's action, most recently saying that they are going to appeal, that they will appeal the California judge's decision, what does that do to the timeline? And there was a lot of excitement within the tech industry earlier this week just about what the judge striking down and not ruling in favor with the FTC, what that could signal for future deal activity in the U.S. Is that a bit premature, Dan?
Yeah, you know, there was a lot of kind of discussion of this is going to happen now, and then the FTC appealed that decision. And so we don't really know where things are going to land at this point, whether or not that appeal will be approved or the original ruling will be upheld. And so, this is a big deal, obviously, for Microsoft. It would make them one of the largest video game companies in the world by revenue, the third largest behind Tencent and Sony, and then the second largest console maker in the world in front of Nintendo, which it lags behind right now. But, of course, you can't talk about anything in tech without bringing up AI. And so along those lines, we had Chairwoman Khan bring up the ChatGPT OpenAI issues that the FTC is looking into. Let's take a look.
Some of the concerns that we're seeing in this AI space is that ChatGPT and some of these other services are being fed a huge trove of data. There are no checks on what type of data is being inserted into these companies, and we've heard about reports where people's sensitive information is showing up in response to an inquiry from somebody else. We've heard about, libel, defamatory statements, flatly untrue things that are emerging. That's the type of fraud and deception that we're concerned about.
Yeah, so that's something that, really I think we're going to hear more about. She couldn't specifically mention anything related to current investigations. This is something that was reported. She said that it's not, we didn't make it public. This is reported, so if it's out there, it's out there. But she wasn't referencing a specific case, but this is seemingly an investigation into OpenAI and the kind of data practices they have with regards to data that's scraped on the internet, whether that's private data that's then put out into the public via ChatGPT. And then, as she said, the kind of replies that they receive, whether they're false or defamatory against individuals, saying that there have been some complaints made to the FTC regarding those kinds of situations.
Alexis, I want to ask, are we expecting to see more lawsuits and targeting of the tech sector from the FTC?
Yeah, in fact, there is a lot of reporting around the expectation that the FTC will also be going after Amazon in a larger way than it already has. These reports say that the agency is expected to go after Prime membership. They've already gone after Amazon in terms of saying that the company is frustrating consumers' ability to sign up and cancel their subscriptions. So that is some of the things that the FTC is saying. But absolutely, Amazon is a big one that the FTC has in its sights as of now.
All right, Alexis Keenan and Dan Howley, thank you both so much. Coming up, used electric vehicle prices are falling even faster than those in the overall used car market. One report says Tesla might be to blame. We'll tell you why on the other side of the break. Used car prices sliding in June, and a new report shows that some of the sharpest declines are happening in electric vehicles. Yahoo Finance senior autos reporter Pras Subramanian joins us now with some insight. Pras?
So, we saw in the CPI data yesterday that used car prices were sort of sliding kind of month over month here, but the drops in EV prices are actually accelerating. IXIC.com, an auto research site, found that EV prices were dropped almost 30% year over year in June, which is kind of astounding if you think about it. And also that these price drops for EVs have been accelerating through the start of the year from January. Kind of why is this happening? Well, a big part of it is Tesla's massive price cuts that started earlier this year and happened again throughout the year, about 5 or 6 cuts this year alone. And why is it the case? Because most of the used EVs out there are Teslas. They are Teslas. So if you can buy a cheaper, brand new Model Y, why would you pay a high amount of money for a used Model Y? So that's kind of a big issue there. So I think what we're going to see now for the data is that probably the best time to buy an EV might be right now, because of the fact that we're seeing that bottoming and possibly some moderation as IXIC.com sees it coming later this year.
And Praj, you mentioned one of the facts is because we have seen Tesla cut their prices. In terms of the models that are seeing the biggest discounts compared to a year ago, where are they, and what are you seeing on a regional basis as well? Are we seeing varying prices, obviously, probably, in certain areas?
Yeah. So across the cars, the top 5 cars with the biggest price cuts were the Tesla Model 3, the Model X, Nissan Leaf.
Oh, wow.
Yeah, because that car is being discontinued.
Okay.
The Model S, of course, which is the more pricier Tesla, and then it's rounded out by the Land Rover Range Rover, which is just an odd car there.
But they always say that one, I think part of the issue with demand is that one caused a lot of trouble for people. I know, it's just an anecdote. One person who gave up theirs because it was just so much trouble in terms of maintenance. People like it. It's, glitzy, glam kind of thing, but yeah. So.
Right, and then the new Range Rover came out just this past year, so that might be part of it. But regionally speaking, I was kind of surprised to see this. The number one spot with the biggest, steepest price cuts were Miami, Florida, then New York City, and then Jacksonville, which is, fine, out a little bit. New York, I was very surprised to see that.
Yeah, why are we seeing that sort of discrepancy in some of these cities? Because New York was not a city that I agree with you. I would have thought was on the top of that list.
I guess because the metro area is it's a big area for cars in general, and maybe there was a huge run-up with pandemic, people buying cars to transport themselves. Maybe that's part of it. Now we're seeing that reverse sort of a equalization, normalization in that.
You gave up your car, like you were a pandemic.
I did. I got a good deal on a car.
Or was it an EV?
It wasn't an EV. It wasn't an EV.
Yeah, so maybe not your next vehicle. Now's the time to buy. Maybe
maybe
EV.
it is.
All right, Pras Subramanian, thanks so much. Well, shares of Meta trading slightly higher on another analyst upgrade following the launch of Threads. We're looking at gains of just about 1%. Cowen upgrading the stock to outperform, raising its price target nearly 60%. One of the reasons that Cowen is bullish, potential upside if and when Meta starts to monetize Threads. Threads so far has been a huge hit, surpassing 100 million users in the first 5 days of the app's launch. For more on this and some of the other trending topics in your feed, we want to bring in Matt Kors. He's host of the Matt Kors Show. Matt, it's great to have you here. So we love talking to you because you have a very good sense, you have a pulse on what retail traders, investors are thinking about really everything. But when it comes to Threads, the launch of Threads, clearly it has been a massive hit in terms of consumer adoption at the get-go. Mm-hmm. How bullish are retail traders on this launch and what it means for Meta?
With this newest battle of the billionaires, there's a lot of excitement. And I think it goes both ways, but for Meta and specifically Threads, a lot of people are talking about it every single day. And I think that 100 million number of the signups, I think that took everyone by surprise. And as the analysts rightfully pointed out, if this can be monetized, which if Meta's good at one thing, it's definitely monetizing its users, I think this could be very impressive for the business. But then that leads to the larger conversation of, will it win out? I don't think so. My personal opinion is that between Threads and Twitter, there's a very realistic shot that both end up coexisting.
Coexist. When you look at just usage in terms of Twitter, it's seen a dramatic drop. We've seen an exodus of advertising. Could this potentially be, because there's been talk of this, a Twitter killer?
I don't really think so. I understand that some of the decisions and some of the things that have played out on Twitter has left a sour taste in some of the advertisers' mouth, for sure. But even today, it was just announced of a new ad sharing program, and a lot of people are sending screenshots of how much they're making. As many people don't like Elon, there's a lot of people that absolutely love him. So that's why I think we're going to see almost a fractured, written social media economy.
So Matt, you think that there's a use case obviously here for both of these companies, for Twitter and Threads to coexist, or both these apps, I should say. What is a use case? Is there a different use case for Threads versus why people would also be using Twitter?
Not a reasonable one that I can come up with. I think it's more of the overall company that they're supporting. Right now, obviously it's new. We're not even a week old. And with Threads, obviously there's some UI and UX that needs to be improved. My personal opinion is right now Twitter is a better functioning app, but also if we give it a couple months, a couple quarters, I'm sure it's going to be like in the same fighting class.
And then you say it's a better functioning. Do you see Meta pulling out that functionality and developing it better? And also speaking to the monetization aspect, I mean, analysts are expecting them to be able to monetize it better in general, like for instance, when you compare it to Reels, which they haven't been able to monetize as well as they'd like. What's your expectation?
I definitely agree with you that monetization will come, but I think what I'm personally more excited about and why I'm actually bullish now on Meta more than I have been in a while is because they've subtly tried to pull away from this branding of metaverse. Obviously, it was a large issue for them, like financially, resource-wise. So they're getting out of that. Stock plummeted from, I believe, 380 all the way down to 80, now up 250%. I think it'll keep going because of what's going on in the world of AI between Instagram and Facebook. They already had a very unique data set. And now adding in Threads, it's a whole nother data set that they'll be able to train their own proprietary AI on. So beyond just revenue of selling ads and whatnot, because it's a little bit more brand safe, we'll say, relative to Twitter, I think the AI play of what they're going to do with the data is very exciting.
All right, Matt, let's talk about another trending topic that I know that you've been watching, and that's a Bitcoin spot ETF. The SEC's decision on Bitcoin spot ETFs is something that has certainly been trending, and all this in the news because BlackRock just last month did file some paperwork to launch its own spot Bitcoin ETF. We spoke to Grayscale Investment CEO Michael Sonnenschein on the show yesterday. He talked about demand, or what demand would be like for this type of product. Let's take a listen to what he had to say.
It continues to show that investor interest and appetite for this asset class isn't going away, and the continuation of Bitcoin futures, Bitcoin levered futures ETFs, these are all additional access points that investors now have. There are trillions of dollars on the sideline, even just in the financial advisor market, that are looking for a convenient solution to give their clients exposure to Bitcoin. So we do think it could be a material moment for Bitcoin, to say the least.
Matt, do you agree? How do you think that a product like this would be received amongst investors?
I mean, obviously, as the CEO of Grayscale, he's far more informed than I am, but I would love to re-echo what he's saying. On top of it, it is definitely a win for crypto and Bitcoin specifically. And today, positive news coming out with Ripple as well. So right now, the SEC is kind of losing some cases while the crypto-loving public is starting to win. But just to throw some numbers on it, what interests me is if we get this spot ETF, that really allows far more people to invest in Bitcoin that never would have before. If you look at the IRA total money in the US right now, it's just over 12 trillion. If you look at 401ks, we're getting closer to 20 trillion. If a small percentage of that now feels comfortable getting into Bitcoin through this ETF because there's just more highway on-ramps for Wall Street to be able to serve this to their clients, I mean, that's not negligible by any means. So for me, this is bullish, and that's probably part of the reason why we're seeing Coinbase, I believe, rip 25% today.
So really quickly, I want to ask you, so yes, it does give more credibility to the crypto space, which has certainly been a concern, especially with the crackdown. But I've heard that retail traders aren't too keen on this. So this, I guess, this institutional push. What is your audience saying about this push into crypto from, say, a BlackRock, Fidelity trying to get in? What are they saying to you?
I think a lot of my retail audience who already enjoys crypto, they did it. They have their own keys, they're storing it on their own ledger, but there's a lot of just the investing public who they don't want to remember a 12-phrase code for them to recover. They like some of the credibility, so I don't think my audience is particularly against it. It's not really for them, but right now, I think it's exciting of how many people will be able to invest in a general sense.
All right, Matt, another big topic for millions of Americans, and that's student loan debt. Borrowers are going to start needing to repay their student loan debt this fall. How do you see this affecting the trader community? Just the amount that people are willing to risk in trades, is that going to affect behavior at all?
I don't think it's the wildest jump to think that it might come down a little bit, but it's tough because we're already coming from quite a peak of record highs in zero DTE trading. So I could see it kind of going both ways, but I do think maybe less money also because of the timing of it. I mean, if the average, according to Morgan Stanley, the average payment is going to be in the realm of $300 to $400 a month. That's $300 to $400 a month. That's not going to be going on flights to restaurants in your trading account. So I think there are going to be some ripple effects, but it'll be interesting to see how it plays out, I believe, starting in October.
All right, Matt Kors, we got to leave it there, but stick with us because we have a lot more to talk with you about. We want to do a check-in on the markets. This is sponsored by Tasty Trade. Check in where they closed, looking at all three of the major averages closing to the upside. The Dow up 47 points, Nasdaq the outperformer on the day. Well, coming up, our Yahoo finance team diving into some of today's top trending stories. Ali Canal, Josh Schaefer here, standing by with what's on deck. Hey, guys.
Hey, Shauna. And you know when you're on a roller coaster ride, maybe at Disney World, and you just love it so much and you don't want to get off? That's kind of like what Bob Iger's doing at Disney.
But sometimes you want that ride to look a little bit different. We're going to tell you what Iger has in store to change up the ride next. I'm really fired up for earnings season to start too. We have bank earnings on Friday, and then you also have Delta reporting on Thursday, and Pepsi also expected to report on Thursday. But I think a key theme when you think about this week is really what have the interest rate hikes started to do to the economy?
I could see some earnings weakness across the board. I think you're going to see a little bit of tentativeness from companies about consumers. I think it's going to be this story about the US consumer, what's going on there, and global growth. Go back, say, 6 months to a year. If you talked about your supply chains being okay, that was enough. Now it's not about supply chains. It's now, are you able to sell your products, and at what margin are you able to sell those products?
There is not going to be any year-over-year sales growth for the S&P 500. That would be the first time that has happened in the past 10 quarters. So not every company's like NVIDIA. Not everybody's selling AI chips.
Goldman Sachs is saying now the key areas that investors will be watching for is maintaining margins, trying to push sales for profits, the impact of bank stresses and credit lending, the potential uses of AI, and also the health of the consumer, how much the consumer is willing to spend.
When all of these companies more broadly talk about earnings, especially within that airline travel experience, we're marching towards some of those key time frames for a company in Delta and many of the others in trying to get back to that full capacity. We've heard from Ed Bastian time and time again that this is the year.
If we look at big banks and even the broader financial sector, they haven't really participated as much in the year-to-date rally, with earnings kind of expectations already being low. It's a sector we like. It's a sector we've been overweight most of the year.
I think it's going to be, not bank's finest hour in terms of earnings this quarter. Clearly, the higher rate environment that was very helpful in 2022 for net interest margins is having a detrimental effect now. You've got slowing loan growth, just less demand as you have much higher interest rates here, and that's the intended effect of the Federal Reserve.
Welcome back to Yahoo Finance Live. I'm Alexandra Canal, joined by Josh Schaefer, Subramanian, and Matt Kors from the Matt Kors Show on YouTube. Matt, you picked a good day because we have a lot to talk about with Disney extending Bob Iger's contract by another 2 years through December 31st, 2026. That contract was originally supposed to end at the end of 2024. Now, 2 years later, there's a lot to get done, Disney says. It still says that the succession plan, who comes after Iger, that's still a priority. But you have to wonder, who could that be at this point? And is Bob Iger ever truly going to be ready to step down? There have been rumors of some internal candidates, some external candidates, but this is a big decision for this company moving forward.
Well, and it seems like the extension, at least just looking at that part of it, makes sense when you think about timeline for some of the things they're trying to do right now, right? When you talk about maybe bringing sports on ESPN a la carte to a direct-to-consumer platform, when you talk about what are they going to do with Hulu, when you talk about some of the stuff we're going to get into about the linear networks, but big things happening at Disney that Bob Iger is putting into motion, it didn't really make sense when you think about the timeline for him to then be done in a year. So I think just overall, this kind of maybe fits what the narrative was a little bit more.
I think it's a reassurance for investors here, right? Coming after that kind of surprise move when Bob Chapek was kind of let go, and Iger brought back kind of like he returns, right? So he's back now, new 2-year contract. We're not surprised to see that. But I mean, is there any talk of who could actually, who is in that succession plan?
We just saw a full screen. Some of the internal candidates, Dana Walden, who leads the entertainment division, Josh D'Amaro, he leads the park division. Could they bring back Kevin Meyer potentially? There's been the Mattel CEO has been rumored. So there's talk.
Tom Staggs, they let him go too.
Exactly. Bringing people go and then they come back at Disney clearly. But like Josh was saying, there's so many issues at this company that although succession probably is and should be the most important thing, it sort of feels like it's in the back burner given all these pressing issues.
I personally, as an investor in Disney, I want Bob Iger there right now. As a famed business operator, I feel more comfortable him pulling off whatever's going on Hulu, ABC, ESPN. So feeling pretty positive about it. And really, even if you look at the stock, it's not a bad opportunity here. About $10 of downside to serious support and quite a bit of upside. So who's leading the helm of the ship, and he's obviously a proven record of doing it before. I think the next 2 years could be pretty exciting with him.
All right, Matt, I want to get your take on what he said about linear networks then. I'll read the full quote of part of what Bob Iger told CNBC in this interview that was sort of the headline of what came out of this. He said that we are expansive in our thinking about the linear business, and we're going to look expansively for opportunities there because clearly it's a business that's going to continue to struggle. You look at the linear networks revenue, down about $1 billion in the most recent quarter compared to last year. Just what do you make of if they were to either scale back linear networks, get rid of linear network? What did you make of the comments overall there?
I just agreed. I thought it was fully spot on. And I think it's something that for all of us who's commonly consuming social media, that's the trend. There's just no popularity there. Of course, it is consumed, but he called it out years ago himself. And he just kind of came back and said, yeah, I was right. So obviously this is the direction we have to go because the market is always changing.
But I got to ask, live sports, live events, that's the driver of linear, right? Is he basically just kind of hiving that off into ESPN and then ABC Family, all the other stuff is kind of on its own?
He basically said he wouldn't define what the word expansive means, but you can surmise that probably that means unloading some of those assets, selling them off. The big question, though, is who's going to buy ABC? He himself said that the linear network business as a whole is broken. The distribution model is broken. So who's going to snatch that up? I don't know.
Yeah, you would think that maybe, I guess it's like most things, there's some parts that maybe are attractive. When you think about live news or something, I think there's always probably room for some aspect of that in these streaming services, because you're going to want some sort of news to go with what you're building out if we fully were to get rid of cable, right? Or you get rid of that part of it. But I think when you think about sports, it's interesting to think about what they want to do with ESPN Plus and go to bringing all of the sports and bringing live sports on ESPN Plus, because that's when they've seen the most subscriber growth in the past, is when they brought NHL games to ESPN Plus, live games. If they're able to do that with this NBA deal that could come up in 24, 25, then I think you're talking about a more attractive product.
And ESPN is clearly the exception here when it comes to some of those cable networks, some of those linear assets, because Bob Iger did say this is going to be an over-the-top direct-to-consumer platform. It's going to happen. We don't know when. He says he has a better idea of when, but he's not ready to say that now. So once that happens, I think it's going to put a lot of pressure on the other streaming giants to get into the live sports game, and it's going to give Disney a competitive edge.
Yeah, I'm sorry, do you want to?
Oh, no, I just agree without a doubt. Obviously, Bob Iger, I'd be willing to bet far better negotiator than I'll ever be. But it's still kind of odd if you're trying to sell something and then in the interview you're like, I'm selling it because I don't want it anymore. It's not good at all. Like, that's weird. But the last time I had the fortunate time of being here, we were talking about ESPN and where that could go. And that touches on what you were saying of, I think out of all of what's going on in cable and all of it as a whole, it is sports. Like, that's going to be the interesting thing. So if I had to guess right now, kind of a Hail Mary guess, I think it's going to be a partnership for maybe better distribution, but I think it's going to a premium paid model.
Yeah, I thought it was interesting too. He gave a shout out to that big company out of Cupertino, right? And their nice headset that might go well with sports. A company that has a lot of money that could maybe help you fund something that might cost $75 billion when you want to buy an NBA deal. We're really extrapolating there, but I do think that's interesting when you think about Apple wanting to get more into sports. Maybe that's where the future of sports watching goes if those headsets become popular. Some sort of merge there. He didn't single out one company by accident, obviously.
So kind of beyond virtual and augmented reality, it's real reality, and that's theme parks, right? So in that same interview, talking about how whether his kind of Disney's feud DeSantis has affected parks attendance, he says, no, we're not seeing any effects there so far. And I'm not really surprised by that if you think about it. I mean, what parent's going to tell their kids, we're not going to go to Disney this year because it's too woke? No, the kids are going to say, we're going, I'm going to throw a fit if we're not going to go. So they went, right? So the attendance is still happening there. I think for someone like a DeSantis, you're taking on the state's largest employer there with Disney. And I think it kind of hurts his sort of business bona fides to go after Disney. And then now with Iger back, he's a formidable guy to deal with.
If you're DeSantis and you heard the news that Iger's on for another 2 years, you have to be like, oh, I thought he was going to be out way sooner.
Through the election, yeah.
Exactly, because this is a feud that's not going away anytime soon. But in regards to the parks, there is a slowdown. The company did say that park attendance is going to, slow down a bit towards the back half of the year due to a variety of factors. That's something that analysts have called out. It'll be interesting to see in the upcoming earnings report in August whether that was the case and what Disney is guiding towards in the future. But Bob Iger, he is very bullish on the parks. He thinks they have a lot to offer. And it's really the one true area of Disney where they get a lot of data on all of these attendees, all of the fans, and that could trickle into other areas of the business as well.
You wonder where it relates to original content too, right? I feel like that's been a big part of the conversation when you talk about Disney trying to turn itself around right now and maybe coming back to some better original content. It seems like a lot of people have been harping on the original content not being as strong recently. How does that relate to then new rides you can build out and sort of get to that next generation? When's the last time a good Mickey Mouse movie came out, right? Like, just as far as getting to that younger generation and coming out with, I don't know if it's new movies with old characters, new characters that connect to that new generation, but it seems like that might be the leg that is kind of missing here that needs to happen a little bit too.
I think you're touching on a very interesting point. Out of the last 8 movies Disney's released, it's a cumulative loss of $900 million. So that could be an interesting focus if they pull that around and then tie it in with the parks to kind of drive more people showing up. Definitely a problem that has to be at least addressed.
Is sort of the Marvel train kind of slowing down? Is that what's happening here? I mean, we're just getting too Marveled out, too Star Wars'd out?
Yeah, I think when Disney Plus was launched, there was this rush to create as much content as possible. So these creators, they were pumping out Marvel series for TV that they haven't done before. They focused on films. They were also doing the same with Star Wars. And that's something Bob Iger brought up. He said, creatively, we weren't hitting the mark. We were pumping out way too much money. So they are going to be pulling back pretty significantly on that content spend. So it seems like the focus here is quality over quantity on the content side moving forward.
And that's really where streamers have been successful, right? And as far as getting people into a show and getting people excited about what they're doing, it seems like doing a little bit less and not sort of force feeding us too much content, because Disney has a lot of characters that people do like, and then when you start forming them into new people and you add all these TV characters and stuff, fans are loyal to those kinds of characters, and I think that maybe there's a little bit of frustration or friction that builds, and that's why some of the shows don't do as well.
Yeah, well, we'll see how this all shakes out. We have until the end of 2026 to see what happens. Matt Kors from The Matt Kors Show, thank you so much for joining us, along with Praz and Josh. And from Disney to Pepsi, we have an interview with Pepsi CFO, fresh off of those earnings on the other side of this break. Stay tuned.
Shares of Pepsi gained some ground today after the company saw net sales jump over 10% in the second quarter and raised its full year guidance. The food and beverage giant wasn't able, though, to escape the impact of price hikes, though, with overall volume in its food and beverage divisions taking a hit. Hugh Johnston, PepsiCo CFO, sat down with Yahoo Finance's Brad Smith, Julie Hyman, and our executive editor, Brian Sozzi, earlier today to break down the company's most recent earnings. Let's listen to what he had to say.
Two sort of broad themes here. Broad theme number one is our top line growth continues to be strong and very broad based. Snacks and beverages both grew over 10%. North America and international both grew double digits. And overall, obviously, we've had a very strong first half of the year. Second theme is productivity. We saw margin improvement both in the first and the second quarter, not driven by pricing, but in fact driven by productivity. So the investments that we've made in recent years in digitalization, in automation, and in leveraging global business services to standardize the company, that's now really manifesting itself in a more efficient company and more margin improvement. And that's something that I think will sustain not just for the back half of this year, but into 24 and beyond. So we're quite optimistic about how the company is performing right now and the fact that the initiatives that we've taken on are actually paying back in our results.
Hugh, it's Brian here. Good to see you. A couple months ago, we were in the same spot, probably wearing different clothes, talking about a guidance raise that I think stunned a lot of people in the street. Now we are back in here today, different close, talking about another guidance raise from a company in PepsiCo here that you know this very well, doesn't normally come out here and raise this earlier in the year. And if you have, maybe not by this magnitude. Are there parts of the business, cost side, product line that are surprising you on the upside and surprising the team?
Yeah, in particular, I'd certainly point to the Frito-Lay business, which is really having a very, very strong year. And it's a product of a lot of what we've been doing down in Frito-Lay, expanding the product portfolio into a broader array of foods, permissible snacking and more food-like products, or more center of the plate food-like products. In addition to that, we've really been putting quite a bit more advertising into the business as well. Across PepsiCo, the advertising budget went up to 50 basis points in the second quarter, and that's something that we think will sustain. So the combination of the investments in the brands, the investments in innovation, and then further gains in distribution as we've made the supply chain both further reaching and more resilient, driving the Frito-Lay business very, very strongly. And there's lots and lots of opportunity left there. In addition to that, international was up 15% in the quarter. So in a time where obviously there's a lot of turbulence in the world, people are coming to our products for that simple treat, that affordable luxury that's frankly making them feel better and enjoying the brand imagery and the products that we create.
Hugh, also the last time we talked to you, Julie here, good to see you. We talked about pricing. We talked about pricing going a bit higher, and you're saying that this time you really saw the gains in Frito-Lay driven by productivity. Where are you on the pricing front? Are you guys done raising prices this year? Have you raised them as much as you've been able to?
Yeah, our pricing right now is in line with our commodity inflation. And that's something I do want to emphasize because it's really not the pricing that's driving the margin improvements. Pricing and commodities are basically exactly the same. As for the balance of the year, I would say TBD. The fact that commodities have moderated, they're still inflationary. And I suspect even as we go into next year, commodities will still be inflationary. And with that, prices will still increase. Now, the rate of increase will come down, but prices will still increase, certainly into next year, and we'll see how the balance of the year plays its way out.
I mean, not all commodities are increasing, Hugh. Wheat prices are down year over year. Oil prices are down year over year. There's quite a number of commodities where there's been a lot of relief. Does that mean that people are going to get lower prices on some products?
Well, no, our basket of commodities, and keep in mind, there's no commodity that even accounts for 10% of our portfolio. So we touch a whole variety of commodities. Our basket of commodities will continue to increase in price. And one thing to keep in mind as well is we tend to forward buy on commodities by about 9 months. It gives us predictability in terms of our cost structure. So anything that you see happening right now won't impact us until about 9 months from now.
Hey, you're almost coming up on that 1 year anniversary of the investment in Celsius. It was a big play for you guys in energy drinks. Since then, I'm seeing this stuff all over the place, new flavors, you name it. We also have Monster out there purchasing up the bankrupt Bang brand. I mean, do you want to make Celsius fully part of your portfolio and realize even greater value from what looks to be a brand that is very much in demand?
Yeah, Celsius is a terrific partnership for us. I think when they joined the PepsiCo distribution system, they were about a 2 or 3 market share, and I think in the recent couple of weeks they probably have gotten close to 10%. So I think we're both doing the things that they do best. They're doing great products and great branding. We're doing great execution in the marketplace and great distribution. I like the deal that we have right now, and I think this deal is going to serve us well for a number of years to come.
Any plans on increasing perhaps the investment there, or if you're content with the deal as it is, any plans to change, expand, enhance?
We may see things evolve over time, but nothing material that would impact the financials in a substantive way. I think we've got just about the right transaction right now. We may refine a few things at the edges, but by and large, I think we're pretty good.
Hugh, I also want to ask you about caffeine content. And I ask because Senator Chuck Schumer earlier in the week was highlighting the caffeine content in a competing beverage called Prime, which he said was marketed to children. We're showing the caffeine content of some drinks. He talked about 200 milligrams for that drink. That's also the caffeine content for something like Celsius. When you guys are making this stuff, how much caffeine is too much caffeine? How do you think about how strong a drink like that should be and who you market it to?
Yeah, I think the caffeine content is pretty consistent across a lot of the energy drinks right now, and that's sort of well inside what people are capable of absorbing. The good news on caffeine is people tend to self-regulate anyway. If you have too much caffeine, you tend to feel jumpy and all of those types of things. As I understand it, and I saw the press conference as well, the concern was more related to how and who it was being marketed to rather than the caffeine levels themselves. And that's something that obviously we've got some fairly strict guidelines on in terms of how we market our products and making sure that we're very, very responsible in the way that we market our products.
Well, that was PepsiCo CFO Hugh Johnston alongside our very own Julie Hyman, Brad Smith, and executive editor Brian Sazi. Coming up, it is closing time here on Yahoo Finance. We recap the top stories of the day and get you set for everything you need to know tomorrow. Stay with us.
Closing time here at Yahoo Finance. Here's a look at some of the top stories of the day. Hollywood is going dark. The actors union SAG-AFTRA will go on strike at midnight after it could not reach a deal with major studios. Now, it is the first time that we've seen actors go on strike since 1980, but this stoppage coming on top of the ongoing writer strike. We haven't seen both unions go on strike at the same time in over 60 years. Upon the news of the strike, Oppenheimer stars Emily Blunt and Matt Damon walked out of the UK premiere of the movie. And this comes ahead of the highly anticipated premiere of Barbie, whose stars will no longer be able to promote the film. The former head of bankrupt crypto lender Celsius Network has been arrested. Alex Mashinsky facing charges of securities fraud, wire fraud, and commodities fraud. He's also facing suits from 3 regulators. Prosecutors alleging that he misled customers and artificially inflated the value of the company's crypto token. He pled not guilty and was released on a $40 million bond. Finally, mortgage rates creeping closer to 7%. According to Freddie Mac, the rate on a 30-year fixed-rate mortgage hit 6.96% last week. That's the highest level since November. A year ago, the 30-year fixed rate was 5.5%.
Let's take a look at what to watch in the day ahead. Bank earnings are set to kick off ahead of the open this Friday. We'll be hearing from the nation's largest banks on their second quarter performance. Citigroup, Wells Fargo, and JP Morgan Chase are the first in line to report as the industry looks to move past the banking turmoil from earlier this year. The Federal Reserve's annual stress test late last month gave banks a boost after the Fed noted large banks are well positioned to weather a severe recession. Investors will be watching to see if JP Morgan Chase will deliver the earnings growth Wall Street is expecting. Meantime, on the economic front, the University of Michigan will be releasing its preliminary consumer sentiment data for the month of July. Now, in June, sentiment saw a 9% increase, reflecting a recovery in attitude generated by the debt ceiling crisis, as well as a positive view over softening inflation. Now, with the latest consumer price index reinforcing the idea of prices cooling, economists will be sure to watch if the consumer still feels optimistic.
We will be watching for that. All right, well, that does it for us today on Yahoo Finance Live. We'll see you right back here again tomorrow. Have a great day.